Something very important is happening right now that I need you to understand. While retail traders are still panicking about last week's crash, while fear is still dominating the headlines, while people are questioning whether the precious metals rally is over, the biggest banks in the world are doing something completely different. They're doubling down. Goldman Sachs just reiterated that there's significant upside risk to their gold forecast. JPMorgan is calling for gold to hit $6,300 by the end of 2026. And both banks are telling their clients that the long-term rally momentum remains intact despite the recent volatility. I'm Mr. AG, and today we need to talk about what Wall Street is actually saying versus what you're hearing from the panic merchants. Because there's a massive disconnect between the fear that is dominating social media and the conviction that is dominating institutional research desks. Gold is hovering near $5,000 right now. Silver just rallied 8% for the second day in a row and is trading around $90 an ounce. The metals are bouncing hard after last week's historic crash. And the question everyone is asking is whether this bounce is real or whether it was just a dead cat before the next leg down. Let me walk you through exactly what the smart money is thinking and why their perspective might be very different from what you've been hearing. First, let's establish what just happened in the markets because context matters. Gold and silver are rallying for the second consecutive day as investors buy the dip following last week's crash that rattled Wall Street. This isn't random buying. This isn't just speculation. This is capital flowing back into precious metals after prices got knocked down to levels that institutional buyers find attractive. And the buying is happening for specific reasons that we can identify and track. The US dollar resumed its slide on Wednesday. This is crucial because a weaker dollar tends to lift commodity prices. When the dollar falls, it makes dollar-denominated assets cheaper for overseas buyers. A Chinese investor, a European fund manager, a Middle Eastern sovereign wealth fund, they all find gold and silver more attractive when the dollar is weak because their local currencies buy more metal. This currency dynamic isn't temporary. The dollar has been under structural pressure for months, and the factors driving that pressure haven't resolved. Fiscal deficits, trade policy uncertainty, relative growth expectations, all of these are weighing on the greenback. And as long as the dollar trends lower, that's a tailwind for precious metals. Now, let me show you what Goldman Sachs is actually saying because I think their analysis is more nuanced than the headlines suggest. Goldman Sachs analysts, led by Lena Thomas, reiterated a significant upside risk to their forecast for gold of $5,400 per troy ounce by the end of 2026. Let me break down exactly what that means. Their forecast incorporates two primary drivers. First, that central banks maintain their recent pace of accumulation. Central banks have been buying gold aggressively for years, diversifying their reserves away from dollars and into hard assets. Goldman expects this buying to continue. Second, that private investors step up gold ETF purchases as the Fed cuts rates. When the Federal Reserve cuts interest rates, the opportunity cost of holding gold goes down. You're giving up less yield by holding a non-interest-bearing asset. Historically, this dynamic has driven significant flows into gold ETFs. But here's the part that should really get your attention. Goldman explicitly stated that they do not account for potential further private sector diversification, and they view this as a source of additional demand that represents a significant upside risk to their outlook. Let me translate that into plain English. Goldman's forecast of $5,400 gold is based on current trends continuing. But they acknowledge there's a scenario where private sector buying accelerates beyond current levels, and in that scenario, gold goes even higher than their base case. They're not saying gold is definitely going to $5,400. They're saying $5,400 is their target, assuming things stay roughly the same, and there's meaningful risk that things don't stay the same, that demand surprises to the upside. That's a bullish statement from one of the most influential investment banks on the planet. And it came out this week, after the crash, not before. Now let me tell you what JPMorgan is saying because their forecast is even more aggressive. Earlier this week, JPMorgan analysts also doubled down on gold. They're forecasting enough demand from central banks and investors this year to ultimately push prices to $6,300 per ounce by the end of 2026. $6,300. That's roughly 26% above current levels. And they published this forecast after seeing the crash, after seeing the volatility, after seeing all the panic that dominated last week. Their exact words were that even with the recent near-term volatility, they believe longer-term rally momentum will remain intact. Longer-term rally momentum will remain intact. That's not hedged language. That's not maybe or possibly or we think there's a chance. That's a direct statement of conviction from one of the world's largest banks. And JPMorgan also provided guidance on silver, which I think is important. For anyone holding silver or considering buying, they forecast a floor of around $75 to $80 per ounce on silver this year. A floor, not a target, a floor. They're saying silver is unlikely to fall below that range. And they added that silver is unlikely to fully relinquish its recent gains. Even after a 30% crash, JPMorgan is saying silver will probably hold on to most of the rally, and that there's a solid base of support in the $75 to $80 range. Now, I want to contrast this with what Goldman Sachs is saying about silver because there's an important nuance here. Goldman's analysts were more guarded on silver. They wrote that in silver, they continue to advise volatility-averse clients to remain cautious. They cited a shortage of readily available silver in the London market that is amplifying price volatility. Let me unpack that because it contains two pieces of information that seem to conflict, but actually do it. The first piece is the caution. Goldman is telling clients who don't like volatility to be careful with silver. That makes sense. We just saw silver crash 30% in a day and then rally 8% 2 days in a row. This is not a calm, boring market. This is a market that can move dramatically in short periods. If you're the kind of investor who checks their portfolio every hour and panics when you see red numbers, silver is going to give you a heart attack. Goldman is simply acknowledging that reality. But the second piece is even more interesting. There's a shortage of readily available silver in the London market. This shortage is amplifying price volatility, but it's also a fundamentally bullish condition. When there's a shortage of physical metal, it means demand is exceeding supply. It means the market is tight. And tight markets tend to move higher over time because buyers have to bid up prices to secure metal. So Goldman is essentially saying two things at once. Silver is volatile and not for the faint of heart, but the underlying supply-demand picture is tight because there's an actual shortage in one of the world's most important trading hubs. Those aren't contradictory statements, they're complementary. The shortage is part of why the volatility exists. When there's not enough physical metal to meet demand, prices have to move aggressively to balance buyers and sellers. Now let me talk about what's driving the rally right now in real time, because the price action isn't happening in a vacuum. Silver is benefiting from a supportive backdrop marked by renewed geopolitical tensions and mixed U.S. macroeconomic indicators. Both of these factors are reviving interest in assets considered safe havens. On the geopolitical front, tensions between the United States and Iran have escalated following military incidents reported in the Arabian Sea. This climate of geopolitical uncertainty prompts investors to scale back exposure to riskier assets and reallocate toward precious metals. Silver is traditionally sought during periods of international stress. It's a hard asset that exists outside the financial system. It doesn't depend on any government's promise. It doesn't have counterparty risk. When the world feels dangerous, investors reach for things they can hold. The Iran situation isn't a one-day story. The tensions have been building for months, and there's no clear resolution in sight. As long as the risk of escalation exists, it provides a baseline level of support for precious metals. Now, let me talk about the economic data that came out this week because it's painting a picture that supports the bull case for metals. The Automatic Data Processing Report, commonly called ADP, showed that private sector job creation in the United States totaled just 22,000 in January. That's well below market expectations. This is a very weak number that confirms a gradual cooling of the labor market. At the same time, the Institute for Supply Management Services Purchasing Managers Index held steady at 53.8, slightly above forecasts. But the details were less encouraging. The employment and new orders components declined, pointing to some loss of economic momentum. What does this mean for precious metals? When economic data comes in weak, it increases expectations that the Federal Reserve might need to cut interest rates to support growth. Lower rates reduce the opportunity cost of holding gold and silver, which don't pay interest. And expectations of rate cuts tend to weaken the dollar, which supports commodity prices. Against this backdrop, investors continue to expect the Federal Reserve to keep interest rates unchanged at its upcoming meetings, while leaving the door open to policy easing later in the year should economic conditions deteriorate further. This is exactly the kind of environment where precious metals thrive. The economy is weakening, but not collapsing. Inflation is moderating, but not vanishing. The Fed is on hold but leaning toward cuts, and geopolitical risks are elevated. These expectations cap the upside in the US dollar and enhance the appeal of silver as a non-yielding asset that tends to benefit from lower real rate prospects and heightened uncertainty. Now, let me address something that I think is really important for understanding the psychology of what's happening. The current rebound also reflects a catch-up move after the sharp correction seen recently. When silver fell from its record high of $121 to around $71 at the lows, it created a massive gap between where prices were and where many investors thought they should be. That correction was triggered by several factors, including the nomination of Kevin Warsh as chairman of the Federal Reserve. Warsh is a former central banker with a reputation for a more restrictive policy stance. His nomination was initially perceived as supportive for the US dollar, which created selling pressure on precious metals. But here's what's interesting. As the market has had time to digest the Warsh news, the panic has subsided. Investors are recognizing that one personnel change at the Fed does not fundamentally alter the long-term drivers of gold and silver prices. Central banks are still buying gold. The structural deficit in silver is still real. Currency debasement concerns are still valid. Geopolitical risks are still elevated. The fiscal situation in the United States is still deteriorating. None of those factors changed because Kevin Warsh got nominated. The crash was an emotional reaction, not a fundamental reassessment. And now, as emotions cool, prices are recovering toward levels that reflect the actual supply and demand picture. Now let me give you some perspective on where we are year to date, because it helps to zoom out from the day-to-day volatility. Year to date, gold is up roughly 14%. Silver is up about 16%. These are strong returns, especially considering we're only about 5 weeks into the year. And they come after exceptional performance in 2025, when gold and silver both had banner years. The recent crash, as dramatic as it was, didn't wipe out those gains. It was a pullback within a larger uptrend, a reset, a shakeout of the weakest hands. But the overall trajectory remains higher, and the institutional forecasts we discussed support the view that there's more upside ahead. Goldman's 5,400, JPMorgan's 6,300. These aren't year-end 2027 targets. These are year-end 2026 targets. The smart money expects significant gains from current levels within the next 12 months. Now let me talk about something that I think is underappreciated in the current discussion: the role of central bank buying. Both Goldman Sachs and JPMorgan cite central bank accumulation as a core driver of their bullish forecasts. This isn't speculation or guesswork. Central bank gold buying is documented and measurable. We can see the data. Central banks have been buying gold at record or near record levels for several years running. They're diversifying their reserves away from dollar-denominated assets. They're building buffers against currency volatility. They're preparing for a world where the dollar's dominance might erode. This buying creates persistent, steady demand for gold. It's not speculative. It's strategic. And it's coming from entities with very long time horizons who are not going to panic sell because of a 2-day crash. When Goldman says their forecast assumes central banks maintain their recent pace of accumulation, they're making an assumption that seems well supported by the data. Central banks have every reason to continue buying, and the factors driving their purchases, geopolitical uncertainty, fiscal concerns, de-dollarization efforts, haven't changed. So you have a source of demand that's large, persistent, and relatively insensitive to short-term price movements. That's a powerful foundation for a bull market. Now let me address the silver side more specifically, because silver has its own dynamics that differ from gold. Silver is both a precious metal and an industrial metal. About 60% of silver demand comes from industrial applications, including electronics, solar panels, electric vehicles, and medical equipment. The other 40% comes from investment and jewelry. This dual nature creates interesting dynamics. When the economy is strong, industrial demand supports prices. When investors are seeking safety, investment demand supports prices. And when both are moving in the same direction, you get the kind of explosive moves we've seen recently. The shortage Goldman mentioned in the London market reflects a genuine tightness in physical supply. This isn't just about futures contracts and paper trading. It's about actual metal availability, and when physical supply is tight, it creates conditions for continued price strength. At the same time, silver's industrial applications are tied to megatrends that aren't going away. Solar power is growing, electric vehicle adoption is accelerating, data centers are proliferating. All of these need silver. And as these sectors expand, so does silver demand. JPMorgan's floor forecast of $75 to $80 reflects their view that there's a solid base of support from both investment and industrial demand. They're not saying silver can't go below that range temporarily. They're saying that if it does, buyers are likely to step in because the fundamental value is there. Now let me talk about how to think about positioning, because I know that's what many of you want to understand. First, recognize that the institutional consensus is bullish. Goldman and JPMorgan don't agree on everything, but they agree that gold is going higher. They agree that the long-term rally momentum is intact. They agree that the crash was a correction, not a reversal. That doesn't mean they're right. Institutions can be wrong. Forecasts can miss. But when the two most influential investment banks in the world are both calling for significantly higher prices after a major crash, that's information worth considering. Second, understand your own risk tolerance. Goldman explicitly warned volatility-averse clients to be cautious on silver. That warning applies to anyone who can't handle seeing their positions swing by double digits in a single day. If that's you, if violent volatility keeps you up at night, then position sizes need to be small enough that you can survive the swings without panicking. Or you might consider gold over silver, as gold tends to be less volatile while still offering precious metals exposure. Third, think in terms of time horizons. The institutional forecasts are for year-end 2026. That's almost a year away. A lot can happen between now and then. There will be more volatility. There will be more scary headlines. There will be more days when selling feels like the right thing to do. The question is whether you have the conviction and the positioning to hold through those periods, because that's what the smart money does. They don't panic sell on weakness. They maintain their positions. And sometimes they add on pullbacks because they're focused on the destination, not the journey. Now let me address something that I think separates successful investors from unsuccessful ones in volatile markets like this. Successful investors have a thesis. They know why they own what they own. They understand the drivers. And when prices move against them, they can ask whether the drivers have changed. If you own gold because central banks are buying, because the dollar is weakening, because debt levels are unsustainable, because geopolitical risks are elevated, then a 2-day crash doesn't change your thesis. Those drivers are still intact. The crash was about positioning and leverage and sentiment, not about fundamentals. But if you bought gold just because it was going up, if you have no understanding of why prices move, then every pullback will feel like a reason to sell. You'll be constantly second-guessing yourself, constantly reacting to the last price move, constantly buying high and selling low. The difference between those two investors isn't luck, it's preparation, it's understanding. It's having a framework for interpreting what the market is telling you. Now let me give you some specific things to watch going forward, because the story is still unfolding. Watch the dollar. As long as the dollar is declining, that's a tailwind for precious metals. The correlation isn't perfect, but it's strong enough to matter. A sustained dollar rally would create headwinds. A continued dollar decline supports the bull case. Watch central bank buying. Any news about changes in central bank gold purchases is significant. If buying accelerates, that's bullish. If buying slows, that would challenge the institutional forecasts. Watch the Fed. Any signals about the path of interest rates matter for gold and silver. Rate cuts are bullish, rate hikes are bearish. Currently, the market expects rates to stay unchanged near term with cuts possible later in the year. Any shift in those expectations will move precious metals. Watch the geopolitical situation. The Iran tensions are providing support right now. If tensions escalate, that would likely push safe haven flows higher. If tensions de-escalate, some of that support might fade. Watch the physical market. Premiums, delivery times, and availability of physical metal tell you about actual supply and demand. The London shortage, Goldman mentioned, is a real signal. If shortages spread or deepen, that's bullish for prices. Now let me address the psychological challenge of investing in a volatile market, because I think this is where most people struggle. When silver crashes 30% in a day, it feels like the world is ending. The fear is overwhelming. The urge to sell is intense. Every instinct screams get out before it gets worse. And then 2 days later, silver is up 16% from the lows. The people who sold in panic are watching prices climb without them. They sold at exactly the wrong time. This is the challenge. Your emotions will lie to you. Your fear will peak at exactly the moment when selling is the worst decision. Your greed will peak at exactly the moment when buying is dangerous. The only defense against this is discipline, having a plan before the volatility hits. Knowing in advance what you'll do if prices drop by 10%, by 20%, by 30%. Making decisions when you're calm, not when you're panicking. The investors who succeed in volatile markets are not the ones who feel no fear. They're the ones who have systems for managing their fear. They're the ones who can recognize when their emotions are driving their decisions and step back before acting. Now here's the reality check I want to leave you with. The crash we saw last week was historic. A 30% single-day decline in silver, one of the worst days in over 40 years. That kind of move destroys accounts for people who are over-leveraged. It shakes out weak hands, it creates genuine trauma. And yet, within days, the market is rallying. Goldman and JPMorgan are reiterating their bullish forecasts. Central banks are still buying. The fundamentals are still intact. That's the nature of volatile markets. The fear is always more intense than the reality warrants. The crashes always feel more permanent than they are, and the recoveries always catch people off guard because they sold in the panic. I'm not saying the recovery will continue in a straight line. I'm not saying we won't see more volatility, more scary days, more moments when everything feels hopeless. We probably will. But I am saying that the smart money, the institutions with billions of dollars and teams of analysts, they're not panicking. They're reiterating their bullish views. They're expecting higher prices. They're treating the crash as a correction, not a reversal. That perspective is worth something. It's not a guarantee, but it's information from people who do this for a living, who have resources and analysis that most retail investors don't have access to. So when you're making decisions about your precious metals positions, consider what the smart money is doing. Consider whether your thesis has actually changed. Consider whether you're reacting to fear or responding to fundamentals, because in volatile markets, the difference between those two things is often the difference between success and failure. Let me wrap this up with some final thoughts on where we are and what might come next. Gold and silver are rallying for the second day in a row. The smart money is buying the dip. Institutional forecasts remain bullish, with targets of 5,400 from Goldman and 6,300 from JPMorgan. The dollar is weakening. Geopolitical tensions are elevated. Economic data is softening. The Fed is on hold with a bias toward cuts. All of these factors support the bull case for precious metals. They don't guarantee higher prices. Nothing guarantees anything in markets. But they create an environment where the path of least resistance is probably higher over time. The volatility isn't over. Goldman explicitly warned about it. Silver in particular will continue to swing wildly because of the physical market tightness and the speculative interest. If you can't handle that volatility, size your positions accordingly or consider sticking with gold. But for those who can tolerate the swings, who have the conviction and the positioning to hold through the noise, the setup looks constructive. The crash created an entry point. The rebound confirms buying interest. And the institutional forecasts suggest significant upside from current levels. That's it for today. If you found this breakdown valuable, hit the like button. It helps more than you think. Subscribe if you haven't already. And share this with someone who's still panicking about last week's crash. I'm Mr. AG, and I'll see you in the next one. Stay sharp out there. The markets are teaching us something right now. The question is whether we're paying attention to the right lessons. One final thought before I sign off. There's a famous saying in markets that the stock market is a device for transferring money from the impatient to the patient. The same applies to commodities. The same applies to precious metals. Last week, impatient traders who were overleveraged got destroyed. They lost money they couldn't afford to lose. They sold at the bottom because they had no choice. This week, patient capital is buying what those traders were forced to sell. Goldman, JPMorgan, sovereign wealth funds, long-term investors who can afford to hold through volatility. The transfer is happening in real time. Wealth moving from the impatient to the patient, from the overleveraged to the properly positioned, from the fearful to the convicted. Which side of that transfer do you want to be on? Because that's the real question. Not whether gold hits 5,400 or 6,300. Not whether silver holds 90 or drops to 75. The real question is whether you have the patience, the positioning, and the conviction to capture the long-term trend instead of getting shaken out by the short-term noise. The smart money clearly has that patience. The question is whether you do too. All right, that's really it for today. Take care of yourselves out there. The markets are volatile, but the opportunities are real for those who understand what's happening beneath the surface. I'll see you next time.